Welcome to the International Resource Management Associates family. Congratulations on your new hire. My name is Chnita Cooper, and today, along with my cohorts, Mikya Coleman, Regi Grace, Courtney Stephens, and William Thornton, we will go through the basic accounting sheets. There are four sheets, and you must maintain the order with these four sheets. The first sheet is the income statement. The second sheet is the retained earnings statement. The third sheet is the balance sheet. The fourth sheet is the statement of cash flow. But we're not going to focus on the statement of cash flow. You will learn that in phase two. Maintaining the order of these sheets is very, very important. For example, the income statement sheet uses revenues and expenses to calculate the net income. The net income is then used in the retained earnings sheet to calculate all of the money that is basically retained at the end of the fiscal year or the month or however the sheet is calculated.
The best way to find out how much money the company has made is by making an income statement. An income statement shows the amount that the company has made over that time period. On your income statement, you will have the revenue, the expenses, and then you have your net income. Your revenue is the amount that the company has earned. And then you have your expenses, that is basically any type of service that the company has got for their company. And then last, you will have the net income. That is the revenue and the expenses added together. When you're looking at your income statement, you have to remember that the left side is debit and the right side is credit. On your right side, you will have your revenue, and then on your left side, you will have your expense. And then once you get all that done, everything will get added together, and that will give your net income. Last, we have the retained earning. The retained earnings is the amount of money that the company has made after all of its costs, taxes, and dividend is added together. Your dividend is the amount of shared profit from your retained earning that a company has from its shareholder. And so once you have your net income, you have if you have any taxes in your dividend, all of that will get put together, and then that will tell what the company has left on your retained earnings.
Hey, I'm here to talk to you guys today about revenue and expenses when it comes to accounting. Revenues and expenses are basically the most simple factor that we use in accounting to understand how well a business, company, whatever you may like, is either producing monetarily, as in money, or expenses if their expenditure is actually overflowing what they're making. Therefore, they're in the negative. And we determine that by the term net loss. Or net loss or net income. Net income can be either positive or negative, i.e. net loss. We find that though by revenue. Revenue is what we make on a daily basis, but we can't factor that into our net income without our expenses. Expenses are how much did it cost us to sell this product, and that would help us get our net income. The formula for that is revenue minus expenses equals net income. Like example, if we were to sell revenue, $3,000 worth of our chicken nuggets today, right? We have $3,000 here, but it takes Chick-fil-A $1,000 for the day to push out their product. So they pushed out $1,000 worth of chicken nuggets, and they gained $3,000 worth of profit or revenue, not profit. So that formula would be revenue minus expenses. 3,000 minus 1,000 equals $2,000. Chick-fil-A would have made $2,000 that day net income gain, which is going towards their equity. Our equity can be either positive or negative. Positive means we can keep the lights on, we can keep people coming in, our business is thriving. Once our expenses start overcoming our revenue, what we're making for the day, our business is in the red, which is where we don't want to be. And that is basically our revenues and expenses.
Hi, all. I'm Courtney, and we're going to talk about current assets today. Current assets can be found on a company's balance sheet under the assets section. It includes cash, cash equivalent, short term investments, accounts receivable, inventory, supplies, and other liquid assets. You determine a current asset by whether it can be turned into cash within a year. If not, it is considered a long term asset. A long-term asset is also found on a company's balance sheet under the assets section. Long-term assets are assets that a company will benefit from in many, many years. They can be fixed assets, such as equipment or property, or long-term assets can be intangible assets, such as investments or trademarks.
So, for your liabilities, this would be your money that is owed for things like your operating expenses, which includes your accounts payable, your wages, and your taxes. There are two categories of this, which are your current liabilities, which are expected to be paid within a year, which have examples like your loans, your accounts payable, and unearned revenues. And then you also have your long-term liabilities. So current liabilities and long-term liabilities. And the long terms are the ones that are expected to be paid outside of a year. These and some examples of these could be your mortgage loans, your bonds payable, and other things that would be just long-term. And the primary difference between these two is just the amount of time between when you would pay these. Some key examples of your current liabilities would just be your short-term loans, your accounts payable, any unearned revenues, your utilities, rental fees, and like your income taxes. Where this would be on your balance sheet. So you have your balance sheets laid out with your assets at the top, then your liabilities. And so it's in that second section, but the first one of your liabilities is current. So very top of your liability section are your current liabilities. So some examples of your long-term liabilities. These would be like your mortgage loans, your bonds payable, any like deferred compensation, deferred revenues, healthcare liabilities, long-term borrowings, just those things that would be either set aside for later or just paid after a certain amount of time, after that year mark. And your long-term liabilities are still in that liability section, but at the bottom of your liability section. They're located just later on when you're listing out your liabilities. The long-term ones would go later. And your long-term liabilities are still in that liability section, but at the bottom of your liability section. They're located just later on when you're listing out your liabilities. The long-term ones would go later. Next up is your stockholders' equity, also known as your owner's equity. This is the amount of assets that are available to business owners after all of the liabilities have been paid off. Some examples of this could be like your retained earnings or your common stock. Retained earnings are earnings that are reinvested into the company after the year end. And your common stock is stock that other people invest in. Inventory and different types of assets are included in your common stock. Your stockholders' equity is located at the very bottom of your balance sheet. So you go assets, then liabilities, then your owner's equity. And you find your owner's equity or your stockholders' equity by subtracting your liabilities from your assets. So it's what is left over after you subtract that liability.
Hi, welcome to the end of the tutorial. I hope this quick reference guide helps build a strong foundation with you as a new accountant.